And Wall Street starts March on a down note as investors digest the latest economic data and wait for a trade deal between the U.S. and China. I spoke with a hedge fund manager about the factors impacting the market. I want to welcome Gabe Hoffman, founder and owner of Accipiter Capital Management, to talk more about what's impacting the markets today. Hi, Gabe.
Hey, great to be with you. Happy Friday.
Happy Friday. We got a big surprise this morning with the jobs report. Just 20,000 new jobs in February, which is, of course, sharply missing expectations for 180,000. But let's look past that headline. Unemployment fell to 3.8%. That's more than expected. And wage growth grew at the fastest pace in a decade. December, January, both revised up. What are you focused on in this report?
Right. And investors need to keep in mind that as far as government statistics go, the monthly job numbers are even more suspect than usual because they're based on a survey, and then you have seasonal adjustments, weather adjustments, and other things. When you smooth out January and February, January being, of course, up near 300,000, you get close to that average of about 180,000 expected. So to your point, the surprise, as I warned or told One American News viewers a couple of weeks ago, look at the wage number, and that was 3.4%, the highest in 10 years.
Yeah, that wage number was, of course, great. As we talk about these job numbers, there has to be a slowdown at some point. Job openings have outnumbered unemployed for months. What's more important for you, number of new jobs, unemployment rate? You said the wage growth. What are you focusing on when we look at this labor market data as it relates to stocks?
Well, investors will be wondering, have we reached full employment where the economy simply can't grow more jobs without triggering accelerating wage growth, which will translate into accelerating inflation? Remember that, of course, wages are approximately 70% of the cost of any good or service.
The White House response is focused on unemployment and wage growth. President Trump focusing on both of those numbers. White House economic advisor Larry Kudlow today is saying this report looks very fluky to him. He says markets will go back up with a China deal. Both the president and Kudlow saying that today. Markets were already down before the jobs report this morning on the latest data from China. Exports fell more than 20% in February for Beijing. How much pressure is China facing to make a deal with the U.S.?
China's facing a tremendous amount of pressure. Their domestic economy is slowing substantially, not only due to trade, but frankly, the popping of a significant credit bubble over in China. So they've got two things to contend with. The key for Chinese leadership will really be to get a deal with President Trump that will still allow them to save face and not be publicly embarrassed, yet produce good results for American workers, particularly American farmers in the Midwest with purchases of goods.
Gabe, of course, the stock market looks at more economic data than just jobs numbers or China trade deals. Other economic indicators coming out today. Housing starts soared in January, up 18.6%. Is this the beginning of a shift in the housing market following a tight year throughout 2018?
Right, and that tells us that the underlying housing market has been stronger than what investors had been focused on in the past. Investors had been looking at the lower growth in home price appreciation slowing in the last couple of months and thinking that portended trouble for real estate. In fact, they were incorrect. What was really going on is in some certain high tax, high cost blue states, President Trump's tax cuts and the end of the SALT deduction was causing some weakness, specifically in very high-priced homes, which was affecting the average. In other words, think about that $5 million home in La Jolla or Greenwich, Connecticut, which is now selling for $4 million. That big dollar discount affected the average price disproportionately. But for everyone else around the country, things are great. All real estate is local, and today's report proved that.
Fed is meeting later this month, the 19th through 20th, expected, of course, to hold interest rates steady as they take on that patient approach to these rate hikes. Beige Book was released on Wednesday. What'd you get from that report from the central bank?
The central bank is on hold, and they will wait at least 1 to 2 more months of data until they potentially make any changes in their outlook. Investors need to look forward over the next couple of weeks, I believe, importantly, to the closing of the corporate buyback window. Corporate buybacks have been a big inflow into the market, almost $1 trillion on an annualized basis. But per the rules of when companies report their earnings, basically the last 2 weeks of a fiscal quarter or mid-March through the first 3 weeks of the next quarter or the third week in April, companies are blacked out from repurchasing their shares. And data has shown that during those times, stocks do tend to underperform relative to the rest of the year. So I do expect continued pullback over the next couple of weeks.
Gabe, speaking of pullback, it's been a pretty rough week on Wall Street after a really strong start to the year. But you and I have spoken before mentioning that this market could be a little bit overbought. Is this kind of an expected adjustment to level out the playing field there?
We've had a very sharp rise from January into February, and so a pullback shouldn't be unexpected. Investors can position themselves a bit more defensively, rotate out of high-priced growth stocks, and rotate into some value names that will provide them with yield if they want to still play the market and potentially, profit while protecting themselves.
Gabe, 10-year anniversary of the bull market on Saturday, longest ever in history. We hit the longest ever in August, now hitting the first ever decade-long bull in history for the U.S. How much longer does this bull last?
I believe you've got at most 3 to 6 months. Frankly, I believe we're going to see another increase in interest rates. Economic expansions and bull markets tend not to just peacefully die of old age, but rather they overheat over time. You get increasing and accelerating inflation. The Fed has to eventually pop that bubble, and because they have a dual mandate, of course, not only full employment, but stable prices. And financial assets are largely based on the price of risk-free or interest rates. So expect higher interest rates in the long run and expect the market to come back in the long run.
Gabe, market coming back, does that mean we see a recession, anything like 2008, or are we past that economically and we're in a different type of economy now than we were a decade ago?
There are imbalances. They're not as severe as they were before the financial crisis. Economic pullbacks and recessions are normal and, in fact, in some ways good, and they refresh the business cycle. The question, of course, for a lot of conservatives and viewers of One America News and otherwise is, will this occur before or after the November 2020 election? That remains to be seen.
All right. Gabe Hoffman, their owner and founder of Accipiter Capital Management. Thanks so much for joining me to talk about everything impacting the markets. Thanks again, Gabe.
Want to see more videos like this? Click on the link below and subscribe to One America News on YouTube. And call your cable provider and kindly demand that One America News is added to your lineup. Call and subscribe today.